Let's be honest, investing is hard. It's complicated and you can't just play around because it's, after all, your money that's on the line. But at the same time, investing is the most reliable and likely tool to help you move upwards in society. It is the most likely way to help you go from lower class to at least middle class. And in my opinion, the hardest part is just getting started. Because there's so much to think about, so many options. And the more you learn, the more you realize that you don't really know anything. And disclaimer, this is not financial advice, you should just treat it as entertainment. In my opinion, just getting started is the biggest one. And with so many mental hurdles to overcome, in my opinion, the hardest part with getting started is just choosing an investment vehicle. Just what you want to put your money into. After all, there are so many different ones, and every single one has a bit different rules. That's why I'll try in this little video to explain them short and simple so you can understand them and decide which one sounds interesting to you. I won't bore you with 50 options that are all mostly similar. Instead, we'll just go through the 8 that are most common and convenient. We'll cover risk levels, how they work and who they are best for. So let's get started. The first thing to remember is that all investments are a matter of risk versus reward. And in general, it always is a line like this. The higher the risk you have, the higher the reward you'll get. Of course, it's not always like this, but that is in general how it works. You'll have safe and steady ones, somewhere probably around here. Those could be high yield savings accounts or bonds. More risky ones like, stocks, somewhere in the middle. Can go well, but you can lose a lot. Or, of course, something at the real high end that I almost consider more as gambling would be stuff like futures or crypto. We'll come back to this graph for every single vehicle and take a look where it falls. So let's look at them going from safe to riskier options. The first one will be a high yield savings account. High yield savings account. Usually these are with a bank. And a savings account, it's in the name. You put the money into the account, it stays there and you get a bit of a return. Not much, but more than, a daily account. These are a safe place to just park your money with a bit of return. Usually these are government protected up to a certain limit. So they are pretty safe. They have low returns, but basically no risk. These are in general boring but reliable. And what do you use them for? Well, the best way is probably to just keep your emergency fund in there. Because then you have it, it keeps growing, albeit slowly, and you don't always have it in your face. You don't always see it as if it is available money. And where do those fall on the risk and reward graph? Well, they're all the way down here. Because you don't get much, but the risk is almost non-existent. The second type are bonds. You can understand them as you lending the government or corporations money. They pay you a bit of interest regularly, and once the duration that you always know at the beginning is over, they return your principal. So they could ask you for 100,000 for 1 year, and every month they would pay you $100 as interest, and after the year is over, you get your 100,000 back. Just example numbers. These are in general safer than stocks and are pretty good as a steady income. But when you consider times of high inflation, like with COVID, the inflation might just wipe out anything you gain from the bonds. After all, if you get 3% a year on your money, but inflation also increases prices by 3%, then you didn't gain anything. So they are very weak to inflation. And on the risk and return graph, they're about here. Not quite as safe as a high yield savings account, but more return. The third type are stocks. These are parts of companies. You know the old pie graph. If this is a company and you buy one share, then this is what you own of the company. It's not much, but you are now a co-owner of whatever company. If the price goes up, you make profit. If the price goes down, you generally make a loss. These guys usually, but not always, pay dividends. And dividends are just a part of the profit the company made in a year. Since you are a partial owner of a company, you're entitled to a part of the profits. Stocks can earn you a lot of money if the price goes up well, if they become very popular. But if the company goes up, all the value is gone and you have lost everything. Who are these for? Well, stocks in general are best for someone who wants to balance out their portfolio. For example, if you have one part bonds, you have high security but low profit chance. If you add in some stocks, you increase the risk but also the profit chance. On the risk to return scale, stocks are somewhere around here. If you know what you're doing, you can earn a lot of money. If you don't, you can lose a lot of money. I'd say individual stocks, if you know a company really well or you're deep inside an industry, you can try your hands with those. But for someone who's just beginning, I just can't see how that's a good idea. The next one are mutual funds. A mutual fund happens when people pool their money together. This money is usually then managed by a professional who buys a mix of stocks, bonds, and other things, which we'll come to a bit later. This leads to instant diversification, which simply means you have a whole lot of different assets to balance out the risk. The price for a professionally managed fund is that the fees can be pretty damn high, as in even 2% per year. 2% a year is not just not unthinkable, it's fairly normal even. I happen to have a friend who started buying a mutual fund during COVID, professionally managed. It lost money and he still had to pay, I think it was 3% per year. So don't be convinced by the label of professionally managed. In the end, they're still just people. Just because it's professionally managed does not mean you will gain profits. Mutual funds usually get traded once a day, meaning bought and sold. If you want in or out, you have to wait for that one trade. And I would say these are best for hands-off investors who want someone, well, whose job it is to invest. On the scale, I would put it roughly here, mutual funds. Not quite as dangerous as stocks if you don't know what you're doing, but if you get a good one, you can make good profits. If not, you can make big losses. And of course, the fees are brutal as well. Our number 5 is the good old ETF. This simply means exchange traded fund. One major difference to number 4, the mutual fund, is that these can be traded at any time. So if you buy in at, 8 in the morning, and then suddenly at 3 in the afternoon you realize you made a mistake or you don't like it, you can go out right then and there. In general, an ETF has lower fees. And I would say an example range for that can be anything from 0.15% to 0.48%. Even the upper limit of this fee is still just a quarter of the actively managed mutual fund. These exist in a variety of assets, from bonds to stocks and even more exotic stuff. For example, once I heard of an K-pop ETF, and I genuinely don't even know what you would buy or sell in that. Usually an ETF tracks an index. That means it follows the market movements. For example, if you track the S&P 500 index, you follow the 500 biggest companies of the US. For example, if Apple suddenly doubles its value in the ETF, Apple stocks will now take double the size. For example, if it was 10% at the beginning and then Apple doubled its value, now the Apple stocks inside the ETF will take 20% of the entire thing. ETFs are super popular for beginners because, well, you have right away a lot of exposure, various markets, you don't have to pick a single company by yourself, and of course the low fees. On the risk to return thing, I put them down here because, well, the risk is low if you pick a diversified one and you don't have to rely on a manager to make the decisions for you because the market does. Our number 6 is an index fund. Now, usually an index fund is a type of ETF, but not always. So I'll put them separately. An index fund passively tracks a market index. That could be, like I mentioned, the S&P 500 or even the entire market itself. Passively simply means there is no active manager at the top shuffling things in and out. If the market moves, the index copies those movements. It's just an algorithm. What that means is low fees. Since there is no manager at the top that needs to be paid, you can often get fees below 0.5%. I think the one I have my money in is at 0.22% annually. And in general, index funds have a historically strong return. And these are best for, well, set it and forget it investors. If you want a savings plan or the like, an index fund is probably the way to go. Risk and return wise, since most index funds are ETFs, I'll put it alongside this. Because genuinely, if you follow the market, how bad can it be? The market usually goes upwards, so if you pick one that's well spread out, you probably won't do much worse than the market. Our number 7 is real estate, which simply means a house or the like. Real estate is always buildings. You buy them, you own them, and then you either sell them or you rent them out. You buy properties, and the profit either is rent when you rent it out, or the profit when you sell it. Of course, one of the hooks for real estate is you generally need a pretty big sum of money to get started. Real estate usually is good for the people who actually want to own their asset physically. I mean, considering how taxes work, you don't really own it, but you know what I mean. I would say real estate is somewhere near the mutual funds, because while you do have a good profit chance, you still have the risk of the property staying vacant, which is just the cost to you, or the prices going down, or accidents like a fire. All of it can happen, which increases the risk. And our number 8 will be a REIT, a real estate investment trust. Man, that's a long name, isn't it? Basically, it's a fund for real estate. Instead of buying one building yourself, you put your money in there and then you own the window of 100 buildings. Usually your profit is either dividends or sale, and you buy in and out just like an ETF. I would say these are good for someone who wants to invest in real estate but doesn't want the hassle of actually managing a physical location. And that's why on the risk and return scale, I would put them beneath real estate even, because you don't have to bother with most of the problems. And basically the honorable mentions will be most other things. That can be cryptos, futures, where you bet whether something will go up or down or on the price, really a lot of options, and commodities. These are basically oil and gold, where you buy the stuff, hope the price goes up to sell it for profit. Now, I consider honestly those all to be closer to gambling more than investing, because what's a crypto? A crypto is a basically imaginary coin that might go up or down at a moment's notice. You don't really have anything. These guys are all super high risk, but have the massive potential of making you rich overnight. But I just can't recommend those for a beginner because, well, yeah, I consider it closer to gambling than anything else. So if you decide to put money into any of these, just consider it playing around, play money. Don't expect to ever see that money again, and at least you'll be prepared for the loss. And on the risk and return scale, they're solidly up here. Because anything from crypto to commodities to, well, options and derivatives to futures, well, they're very dangerous. But how do you actually choose which vehicle you want to use for investing? After all, even just those 8 or 9 were already quite a lot to think about. Well, ask yourself, what is your goal? Is it to prepare for retirement, to buy a house, to fund your next vacation? What is your timeline? Do you have 1 year, 50? What's your risk tolerance? If you're young, you can probably take a hit or two, because time will make up for it. But if you're 55 and you want to retire, then I don't know if I would gamble everything on that one big win. But if you watch this video, then let's not kid ourselves. You're not a super high stakes mega investor. You're probably a beginner. So the starter path, open a broker account, whichever strikes your fancy. Start with a simple, widespread index fund, an ETF, not an actively managed one, because the fees will just eat you up, and dollar cost average. Which means don't wait for the market to go down before you buy. Just buy right away, consistently over a long time, and the cost will average out. Do that for a long time and you basically won't lose, because it all grows over time. Just don't overthink. Pick one that sounds good and be consistent. It's that simple. It might be scary at the beginning, but start small, learn more, and you'll grow. It's a skill like any other. In the end, investing isn't about picking the perfect vehicle. It's all about getting started and being consistent. It's that simple. So, down in the comments, tell me, which one are you most interested in? Maybe I'll do deeper videos on that, maybe some comparisons, some examples. And if this video helped you cut through the noise, through all the guru nonsense, leave a like and subscribe. I appreciate it. Your future of self and mine will thank you.